Hello again and welcome back to this course on commodity spread trading, and congratulations for making it this far. As I said at the outset of this course, there would be a lot to learn, so well done for sticking with it. So far, we've covered the basics of what raw materials are, explained the simple principles of spread trading, and also looked at the basic fundamental analysis you need to understand in order to maximise your trading ability. In this, the fourth section of the programme, again, as ever, divided into two videos, we will walk through the technical analysis that we recommend you always use in commodity spread trading. This, in conjunction with the information obtained from the fundamental analysis, can identify which trades to focus on and which ones to walk away from. Specifically in this video, we will talk about certain signals that the technical charts can alert you to, and also other signs that you can use to ensure your proposed trade will be the right one to make. Before we start looking at the technical analysis, a little reminder from the last two videos. Understanding and undertaking fundamental analysis is vital to helping you identify potential trades and opportunities in the market. But remember, what opportunities you identify when undertaking fundamental analysis, regardless of how good an opportunity they appear to be, should never be the sole basis for making a trade. Only, and I cannot stress only enough, when you've confirmed the potential of an opportunity through technical analysis should you look to trade. Run the numbers through the platform as a practice trade. That way you can determine what the potential outcome will be. Time spent testing and proving your proposed trade before you undertake it is time well spent. You can then place the trade comfortable in the knowledge that it will provide the return you expect it to. You won't have to spend countless hours in the day after placing it, checking every movement and worrying about whether it is the right thing to do. Instead, you can sit back, relax, and watch your profits grow. Now, the signals that come from technical analysis you undertake are undoubtedly more precise than the entry and exit points proposed by the statistical databases. This analysis can be used to correct those dates that are only calculated based on historical info. What we need to understand is how to amend and adapt the information for the current market conditions. Now, we know that the markets have three trends, i.e. a sidewards trend, an upward or a bullish trend where the price rises, not necessarily in a straight line as there may be some small reversals, but over time the general movement is upwards, and a downward or a bearish trend, again where despite slight retractions the price of the spread ultimately falls. It is important to understand and identify when a trend is starting, or when it's in its final phase, to optimise our entry into or exit from the market. We can do this by looking for the signals that come from the charts. One specific signal that is commonly used is what is known as the 1, 2, 3 signal. No matter how far markets move, there will always be room for a market reversal when the fundamentals which push the previous trend change. The 1, 2, 3 reversal pattern shows such market reversals before they occur, so at the time of the reversal you will be ready and waiting to pull the trigger. Identification starts with the movement of a price seen in the charts. A typical low 1, 2, 3 will form at the end of a bearish trend, where the direction of the price has been downwards. Typically, prices will make a final low, indicated here as point 1, then proceed upwards as the trend shows the first signs of reversing to the point shown here as point 2, where it begins a slight downward correction, proceeding downwards to a point at which it starts an upward movement again, thereby creating a pivot point indicated here as point 3. Remember, there will need to be more than one bar of movement from point 1 to point 2 and also from point 2 to point 3, but the pivot point should never be lower than where the first upward movement was seen at point 1. There should also be a maximum of 2 sessions or trading days between one point and the other. If the correction takes longer or the pivot point is formed lower than where the trend appeared to reverse, the signal could prove to be dirty or false, and if acted upon, might not present the outcome expected. The same type of movement can be used to identify the end of an upward trend. Here we see that the direction has been bullish before the market starts to reverse and move downwards. Point 1 signifies that a high has been reached. Again, the formation of a 1, 2, 3 signal will mean that having reversed the trend, there will be a slight correction starting as shown here at point 2, where the price makes a slight upward correction before once again reversing at the point shown as point 3, which becomes the pivot as the reverse trend is confirmed and the price falls. Now let me explain a double benefit of the 1, 2, 3 signal. You can take advantage of a 1, 2, 3 signal, using it to identify the right time to enter the market. If your analysis points to going long of the spread, for example, you can monitor the market to identify when a reversal to a bearish movement is about to occur, signalling the right time to execute your trade. But on the flip side of things, when you have a spread position open, you can use it to identify when the trend you've been following is coming to an end, signalling that it's the right time to close that position off. The first aspect we need to identify and consider in evaluating a trade is the level that the spread price has fallen or risen. It's only advisable to trade on the back of a substantial rise or fall. But the direction and size of a price movement is not the only factor to take into consideration. We can look at information from another indicator to confirm the actions that we want to take. Designed by Wells and Wilder, the RSI, or Relative Strength Indicator, is probably the best known indicator used by traders worldwide. The RSI is used to highlight overbought or oversold conditions on a particular instrument. The indicator chart moves within a band between the values of 0 and 100. On the chart shown, the band is identified towards the bottom of it. The values shown by the lower red line and upper yellow line are 30 and 70 respectively. The higher level 70 is where it's normally said that the market considers the instrument has started to be overbought, whilst the lower value 30 indicates that it started to be oversold, and the mid value of 50 shown by the blue line represents neutrality. Any value above 50 shows that there are more buyers in the market, whilst a value below 50 indicates more sellers. RSI is based on the assumption that after a prolonged period of upswing or downturn, the movement in price tends to slow down, normally as a result of traders unwinding the excesses that they've either bought or sold. Now, time parameters for the reference data can be changed. In this chart, we're viewing an RSI with market activity over 14 periods, or recorded every 14 days. But now we see an RSI over 7 periods, and this tends to be the parameter that we want to use. If the time period used to calculate the RSI is reduced, it will have the effect of increasing the oscillations of the indicators as more data is available, which in turn will identify more cases of the market being overbought or oversold. In this example, it would be preferable to intervene by buying the spread or going long of it when the RSI is below the value of 30, and conversely sell the spread or go short of it at a level above 70. These are shown by the directional arrows at the bottom of the chart. However, attention also needs to be paid to the information that's coming from the spread chart, as there are occasions when the chart could be indicating that the market is moving in the opposite direction to that indicated by the RSI. We can see this by looking at the trend in the top line, where the directional arrows are conflicting with the information seen from the RSI. It should also be noted that sudden large price movements can create false buy or sell signals in the RSI. It's therefore best used in conjunction with other confirming technical indicators rather than a standalone means to confirm any potential opportunity. Okay, so this video has come to its conclusion. I hope you've enjoyed looking at the first part of technical analysis and have understood why this needs to be done, why there is a need after identifying possible trades through fundamental analysis, you need to confirm any opportunities before you place your trades. As we've seen, we can identify when a price trend is about to change in order to maximise the potential of the opportunity, but also use that same information to close a trade to maximise the gain taken from it. But as ever, any analysis undertaken on its own is never enough. We can still get false signals from data that, if acted upon without further confirmation, could result in losing trades. That means lost money, and that's not something we want to suffer from. In the next video, we'll continue with technical analysis, in particular looking at Bollinger Bands, historical correlations, and the impact that large institutions have on spread trading. I'll speak to you soon. Bye for now.